Good morning, everyone. Thanks for joining us on our discussion of the new guidance on parking expenses for unrelated business taxable income. So today, I and Rachel are going to be speaking with you about this topic. For those of you that haven't met me, I'm a managing director here at Bekaert. I sit in our Atlanta office, and I lead the nonprofit tax services for the firm.
Hey, good morning. I'm Rachel Gibbons. I'm in our Greenville, South Carolina office, and I work with Amanda on our nonprofit tax services team.
Both taxable entities and tax-exempt organizations may provide transportation benefits to their employees, including parking on owned or leased property and transit pass and voucher programs. Parking arrangements may be reserved for employees, but shared with others exclusively for employees or not reserved at all. Costs of the plan can vary as well. Parking might be free, employees might pay for parking pre-tax or after tax, or employers may completely pay for parking. Similarly, with respect to transit passes, employers may pay or employees may bear that cost on a pre-tax basis. So Section 132 excludes from gross income many of these transportation-related fringe benefits, so they're not taxable to employees. Prior to the Tax Cuts and Jobs Act, these costs were deductible, but new Section 274 now disallows these deductions to for-profit employers. The Tax Cuts and Jobs Act, new Section 512A7, makes this an issue for tax-exempt organizations. So this new code section is intended to align taxable and tax-exempt entities in the treatment of transportation fringe benefits. What we're going to talk about today is new Notice 2018-99, which provides further guidance on this new code section 512A7. So first we're going to go through a general Q&A about the notice, walk through some examples, and then discuss some implementation considerations. That brings us to the first polling question. We'd like to kick things off by discovering whether you believe your organization may have tax due as a result of the new tax on qualified transportation fringe benefits. So the options are yes, no, not sure. We just kind of want to get a gauge of where you're thinking you land in terms of this, if it affects you. All right, looks like we're almost complete here. And looks like we have almost 50% saying yes, and the rest are split between no and not sure. So hopefully the not sure will get the information they need to make a final determination by the end of this webinar. So let's kick off the general Q&A. First of all, what is Notice 2018-99? Rachel, can you help us out here?
Sure. As Amanda mentioned, when the Tax Cuts and Jobs Act passed back in December of 2017, it brought into this new code section that we're having to deal with, the 512A7, that basically created issues for employers who provide parking to their employees. The Jobs Act basically told us that we had a problem, but didn't really give us any way to quantify the fact that this was now going to be treated as an increase in unrelated business taxable income. And so what Notice 2018-99 gives us is just a little bit more meat to kind of what the IRS is thinking of as they look at implementing proposed regulations in this area to help us quantify what may now be potentially taxable income to nonprofit organizations.
So does this notice provide us with final guidance on implementation of the new rules?
No, it doesn't. Unfortunately, it's just interim guidance right now. And so the IRS is still, up until the end of February, they were requesting comments on items that they're still trying to kind of wrap their minds around and how they want to address implementation. So what this did was just get us some examples about what the IRS was going to consider, things for taxpayers to consider as they implement these new regulations. But we're still in an interim situation, and we're still waiting for proposed regulations. This is just trying to give general guidance to taxpayers in implementing these new rules.
So do these new rules impact every employer, or does it only affect employers that are paying a third party to provide parking to their employees?
Yeah, that's a good question. I think when this first came out, a lot of people thought because they owned their own parking facilities that they weren't going to have an issue, and that it was going to be more for employers who were paying directly, like say for leasing space in a garage downtown, specifically for their employees. But unfortunately, this is going to impact basically every employer who provides parking for their employees, whether they're a for-profit organization or a nonprofit organization.
So why does this apply to nonprofit organizations?
That is the question I think we've all been asking ourselves for over the past year. I think when these rules kind of originally took shape, the thought was that employees who received this kind of, in quotation marks, fringe benefit for parking, whether they worked for a for-profit employer or a nonprofit employer, should be treated the same. And so for-profit employers were told you're not going to be able to deduct these expenses since you're providing a benefit for your employees and they're not picking it up as taxable income. They wanted to kind of expand that to all employees, regardless of whether it was a for-profit or nonprofit employer, but it didn't really take into account the differences in the nonprofit sector because, by and large, most organizations aren't deducting expenses for parking, and most organizations, or a good number of them, don't even have unrelated business income. And so it really was just, I think, an oversight and a lack of understanding for the people who are generating these rules and regulations in really understanding how the nonprofit sector works, both from a compliance standpoint and from a taxable income standpoint.
So given this, I know I've heard a number of exempt organizations, complaining about the new provision and, writing their congressmen and urging others to write their congressmen and women. Do you think that there's any chance that this could get repealed?
I think we're all hoping that this will get repealed, but as of today, we have no indication that it's going to be. I think to date, I've seen about 5 or 6 different pieces of legislation that have requested repeal on some level and with different ways to implement the repeal. But currently, I think probably one of the bigger problems is that there were so many changes to the tax code as a result of the Tax Cuts and Jobs Act. This just does not rate high enough on the list in the grand scheme of things. And so I thought this quote from the National Council of Nonprofits was good, and I think it's basically how we feel at Cherry Bekaert. We just don't know whether or not this is going to get repealed at this point. So the best course of action is just to realize that this is current law and that your organizations need to comply with it, and look at, how can we mitigate the implications to our organization while still being compliant with respect to the regulations until if something does get repealed, we'll have to just wait and see like everybody else.
Good point. That brings us to polling question 2.
Yeah, and this is just kind of, so how does your organization provide parking to its employees? Do you pay a third party? Do you provide parking through a facility that you own, or do you provide parking through a facility that you lease, or some other method? Let's give a minute for everybody to answer.
Yeah, I think typically what I've seen, Rachel, is that, some of this depends on, the geographic location of the organization, with, certain organizations that are right in the heart of urban areas paying a third party when they're leasing space for that parking, and those that are sort of outside those areas or that own their own building or owning the facility that they're providing parking in.
Yeah, I think that's true. And I know we have a lot of clients that have locations, multiple locations. And so depending on where that location is, they may have some mix of all of these. I guess we can go ahead and close out that poll. It looks like we've got everybody on that one.
So what do I need to know to be able to consider the impact for my organization? I'm providing parking to my employees. What else do I need to know to be better prepared to analyze whether I have UBI, and if so, how much?
Yes, I think since really all of this kind of hinges on the definition of a qualified transportation fringe and what the IRS in the code defines this as, we have to kind of understand what this is. There's transportation in the commuter highway. You see that first point. I don't see that as much. The two main ones that we're seeing would be transit passes, and even that not as frequently as the qualified parking. So let's go ahead and talk about what that qualified parking is. And this is basically if you're providing, oh, sorry, Amanda. This is basically if you're providing parking in any way to an employee, that's key. I've had clients ask whether or not they need to consider this for independent contractors that come on to their facilities, but you're looking at the relationship in the context of an employer providing a benefit to an employee. And so you're really just looking at your business premises and whether or not you're providing parking to your employee. And if you have somebody who works remotely, it doesn't include parking near their residential facilities.
So who's considered an employee for this purpose?
Yeah, so the notice does point out that for purposes of implementing the notice, an employee is going to be basically a common law employee, and other statutory employees would mainly be officers of corporation that you might have that would be considered a statutory employee. They point out these other caveats: S corporation shareholders, sole proprietors, and independent contractors aren't going to be considered employees for this purpose. And that's going to be impact more the for-profit arena. But so you're mainly just looking at employees who you're providing parking to.
So here's the million-dollar question. I know that a number of fiscal year organizations are mostly concerned about this one. When is this new law effective?
Okay, so the law is effective for expenses paid or incurred after January 1 of 2018. So you're looking at 1/1/18. The hard part about this for a lot of organizations is that the rules came out with an effective date, but we didn't really get any guidance until almost a year later. And so it really created problems for a lot of people, especially fiscal year filers. Let's look at some examples. Okay, so in this first one, you're a nonprofit and you have a calendar year end. You're going to have to look for your upcoming 990 filing for expenses paid or incurred from 1/1/18 through 12/31/18, so your full calendar year, and that's going to get reported on the 2018 Form 990T. The IRS has added a new line, I believe it's line 34, that's called amounts paid for disallowed fringes, and that's where this item is going to be picked up on your 990T. You may not have historically filed a 990T before, so if you're not filing by the May 15th deadline and you're used to extending, that's going to have to be something to consider because the 990T is a separate extension from the 990. And so that is how, so this for calendar year organizations, you're just going to be dealing with this coming up in the next few months as you look at your May 15th filing deadline. Now, in the second example, if you're a fiscal year filer, this became effective on your 2017 Form 990 filing, and you may still be working on that filing. But because it became effective 1/1/18, you're going to have to look at expenses paid or incurred from January to the end of wherever your fiscal year is. In this example, June 30. So for a June 30 year end, you'd look at expenses incurred from January to June of 2018. So you're only picking up a partial year. It's going to be on the 2017 forms. I will note that the 2017 forms don't have a specific line item. The forms were issued before this kind of came into play, and so we are reporting that, and I believe the IRS kind of issued guidance that says you can report that on line 11 as other income, and we've just been calling it amounts paid for disallowed fringes, just like the 2018 forms do. But that's where it's going to get picked up.
All right. So what expenses need to be considered in making this calculation?
Okay, that's this is going to be kind of like one of the heart and soul of the calculation when you go in and look at this. And this is what the notice gave us guidance on. And it lists a number of expenses. You can see them up on the screen as to things that need to be considered. You have one situation where you're paying amounts for a third party directly for parking. Think about an employer who has a parking garage, in a downtown area, and they're just paying that third-party garage for their employees to be able to park there. You also have other costs that the notice said that you need to consider. This list in the notice was said it's not all inclusive. You may not have all of these expenses, or you may have other expenses that factor into your parking situation that aren't covered here. But the notice was just intended to give some general guidance on that. And so you can see insurance, property taxes, utilities, all these costs. The key question then becomes, how do we allocate costs? And we can kind of talk about that as we go through some of the examples.
What expenses can be ignored? So we went through some things that the IRS has given as examples that need to be included, but what can we specifically leave out of the calculation?
I think the biggest one that everybody was waiting to hear about was depreciation on the parking facilities themselves. And so the good thing about the notice was that it specifically said that the IRS did not consider depreciation to be an expense that needed to be included in this calculation. And so that was a big win in some respects, that we're not having to include depreciation on your parking facilities in this calculation. The only other expense was more in a general idea of kind of clarifying that when you're looking at your parking facilities, you may be incurring general costs, for example, landscaping or utilities, that you're only looking at allocations with respect to expenses specifically in the parking facilities themselves, the parking lot itself. You may have landscaping that's done or utilities that are adjacent to the parking facilities, but you only have to consider expenses within the parking facility itself.
Yeah, I've had a couple of interesting items come up with respect to this question. One of them being that, a number of organizations have a relatively high threshold for capitalization of items for accounting purposes. That could be $5,000 or it could be even higher. And so one thing that you might need to consider is that you might be expensing an item relating to your parking facility under your sort of threshold policy, but that might really be a capital item for tax purposes. And so that could potentially fall under the type of expenditure that would not be an expense for this purpose because it's actually a capital item. But it would be important to make sure that you checked and verified that that definitely was an item that was required to be capitalized for tax purposes. Another interesting thing that has come up is thinking about, organizations that have specialty type parking facilities that are used by employees from time to time, but perhaps the main purpose might be, for example, like stadium parking or like athletic facility parking, where perhaps there may be some expenses that only relate to times when the public would be using them. So like, for example, lights being on at night for games, where that would be sort of public usage, not employee usage. And it might make sense to exclude those types of expenses from the total pool being allocated because there wouldn't be any connection to employee usage.
Yeah, let's go ahead and move into our third polling question. Okay, does your organization's accounting system currently track expenses related to parking? Yes, no, or not sure? I think this has been probably one of the hardest things for people to kind of do with respect to implementation is figure out how are we going to capture our expenses, and then an even bigger portion is how are we going to determine for expenses like insurance or property taxes, how are we going to determine what is a reasonable allocation? I know we've done a lot of phone calls with clients just trying to talk through different calculations that they've come up with and kind of just helping them walk through and talk through those expense allocations to kind of get to a meeting of the minds and kind of just thinking through different aspects of implementation of what expenses need to be captured and then how do we need to allocate. I guess we probably got everybody at this point. Let's go ahead and close out that poll.
So what do I need to know specifically about the parking spaces that our organization provides?
Yeah, and so this slide is really just put in there as a reference. I mean, one of the first things you're going to have to do as you go through and begin to look at this for your organization is you're going to have an understanding of your parking facilities. I know, for example, our educational institutions have been dealing with their facilities management team to try to get counts on the number of spaces on campus, but you're just going to have to understand and have, actually count, or to have somebody go out there and figure out the number of spaces your organization has, and then not just that, but what's the component of that. And so you can see the different buckets that we've got here: number of spaces reserved for employees, number of spaces reserved for non-employees, like visitor spaces that are specifically reserved by signage or marking in some way, an estimate of the number of spaces used by the general public, the number of non-reserved spaces that are empty on a typical day, and then the number of non-reserved spaces used by employees. You'll see as you get into the notice why all of these matter. They're all a part of the calculation that the IRS gives as an example as we go through the steps of determining a reasonable method for allocating expenses. So these are kind of the different buckets that you're having to look at. And then these are just kind of some clarification. When we talk about the number of spaces reserved for employees, it could be a space reserved for a specific employee, like the president of the organization, or just whatever specific employees have their own spot. It could also be just spaces that are reserved that are staff-only parking, employee-only parking, that are designated either by signage or just some barrier to entry, but basically where you've got employee-only parking that's distinguished from your general parking spaces. You're going to have to look at that in the context of that the IRS would consider that spaces reserved for employees. It becomes important as we look through the calculations in the next couple of slides. Now, a lot of what Notice 2018-99 is it talks about how does an organization establish a reasonable method, and what is the IRS going to consider as a reasonable method. And so what the IRS came out and said was that this is information that we didn't have as we were trying to kind of wrap our minds around this earlier in the year before the notice came out, is the IRS said if you have spaces that are designated for employee only or specifically reserved spaces and you don't allocate any expenses to them, that's not going to be a reasonable method. But they did put one little caveat that we feel is important in this consideration, and that they specifically state in the notice that for taxable years beginning on or after 1/1/19, that if you fail to allocate expenses to these reserved spaces, that's not going to be a reasonable method. We really believe that has to do with the fact that the guidance came out so late, and that the IRS wanted taxpayers to know that they realized the taxpayer may have come up with a reasonable method with respect to implementation of these rules prior to the notice coming out, and that just because the specific method didn't take into account this category does not necessarily make it a method that's not reasonable. But it is important to note that for tax years after 1/1/19, if there's no specific allocation done to these reserved employee spots, that's going to be a problem in being able to make a reasonable standard under the notice as far as what we have issued to date. And so this is just kind of clarification, different questions that we've had come up. It's a key part of the calculation is going to be looking also at spaces used by the general public, so spaces not used by employees. The IRS clarified in the notice that if you have spaces used by customers for hospitals, if you might have patients using that for educational facilities, students, if you're a church or religious organization, you might have parishioners or congregants who use that space. Use of those spaces is going to be considered use by the general public, and those are that's a good thing, because the more spaces you have used by the general public, the less amount of expenses that you're having allocated to employees, which is going to help in the total calculation. So the IRS came out and said, okay, these are going to be treated when you're categorizing your parking expenses. Spaces used by these types of individuals are going to be considered used by the general public. And then when you look at the number of, you may have spaces that are typically empty on a typical day, and if they're non-reserved, so they're not in your reserved spaces, if they're non-reserved spaces and they're empty on a typical day, then you get to treat those as used by the general public.
So what other information should be considered in making the allocation?
Okay, one question that's come up a lot is if you have facilities in more than one location, you may have multiple lots. The IRS kind of just briefly spoke to this point in the notice, and they said if you have parking facilities in more than one geographic location, that you can group those if they're all in the same city. So they give an example where you've got different facilities, that may be adjacent, for example, on a university campus, or maybe you just got a downtown facility, and then you've got one in a more rural areas. Whatever it is, if it's in the same city, the IRS has said you can group those and treat those as one facility when you go through and do the calculation. I will point out that it says that you can, but it doesn't say that they're required to be grouped. You just have to come up with a reasonable method. And so as you analyze your parking expenses and your parking spaces, this could provide a planning opportunity. So it might be a good idea to kind of look at if you have a lot of expenses being incurred in one lot. You may just kind of want to look through that to consider how are you going to group those things. But again, we want to keep in mind that we remain under this concept of we have to do a reasonable allocation method.
Yeah, I had one other item I wanted to add here, which is kind of going back to Rachel's point about the IRS's instruction that a reasonable method for allocating parking expenses for tax years beginning on and after 1/1/19, there was the mention of that reasonable method needing to incorporate reserve spots for employees. The other important factor that they had identified was that you could not base the allocation on the fair market value of the parking, i.e., by making the claim that because the parking has no value, therefore no expenses need to be allocated and there's no unrelated business income. I think that was in direct response to a number of organizations and tax advisors prior to the guidance coming out were kind of putting that out there as a potential method, basically making the analogy that if the parking didn't have a value, then no qualified transportation fringe benefit had been provided. Therefore, it would not be necessary to calculate the expenses related to providing the benefit. The IRS seems to be adamant on this point that since the new tax code references and defines the unrelated business income amount based on the expenses incurred for providing the benefit rather than the value of the benefit, that would not be a reasonable approach to take. Now, again, that is for tax years beginning on 1/1/19 or after. So by that implication, if an organization had taken that approach prior to that time and not quantified any expenses, kind of following that methodology, it seems like that could have been a safe approach to take. All right, so another common question that has come up is, well, so we were previously providing this as a pre-tax benefit to our employees. What if we just make this a taxable benefit to our employees? Does that solve the problem?
Yeah, I think the hard part about this was that the rules with respect to what is not gross income under 132 didn't change. And so we've had a situation where what has changed in the income tax treatment hasn't necessarily changed for employment tax purposes. And so let's go ahead and move into the next slide because they're kind of related. We've had a lot of questions in this area, so I just want to make sure we touch on it. So there's going to be two different scenarios. I'm just going to talk off the slides and let Amanda let you chime in on kind of the discussion we had on this. So you've got different situations to consider, but some organizations charge their employees for parking. The little gray arrow on the left is talking about since you're charging, you're bringing in revenue by charging your employees for parking if that's the situation you have. We don't have to worry about the income stream from employees being parked UBIT because it should be excluded under the convenience exception. What we don't know is whether or not this is going to be excluded and kind of get your organization out of this qualified transportation calculation for UBIT tax purposes. I think the IRS is still trying to weigh in. I think there are people who are taking that position, but it's not been substantiated yet that the IRS has said, yes, that's going to work. They're still asking for comments on this issue. It might be excluded from the new tax provision since you're not providing a benefit, you're charging them. But one of the questions that comes into play is, are you charging fair market value? Amanda, I'll kind of let you chime in on this issue.
Yeah, I think that's sort of the biggest consideration because based on some of the parking arrangements, that we've heard of, for example, there might be different pricing structure for students versus employees. And so that might be an indicator that, since employees are paying less, that they might not be paying, the full fair market value. There have also been other cases where both students and employees are being charged a kind of a nominal amount that might not be representative of fair market value. And so I think, there is going to need to be some guidance as to, sort of that whole spectrum of situations. It seems to me that it would be reasonable if they've, paid fair market value, that there is no fringe benefit. It is basically a quid pro quo transaction. But for those situations where they're paying less than fair market value, what would be the approach? Would you simply reduce the expenses you had for providing the benefit by the income that you received from employees? Would you prorate it based on the value, maybe taking what they paid over the fair market value and multiply that by the expenses? So there could be a couple of different ways to look at it. I think kind of right now, again, since that is an unanswered question, organizations have quite a bit of latitude in determining what seems the most reasonable approach for their circumstances. So given everything that we've gone through, and we know that employers have employees, are there any employers that don't have to deal with this new parking tax, or does this pretty much affect everyone?
It's going to affect a lot of people, a significant number of employers. There is one caveat. If you aren't paying a third party, actually having, specifically paying for third party parking for your employees, for example, the garage downtown example where you're paying a per employee fee for that employee to park in that third party owned garage. So you don't have that going on, and you don't have any reserved spaces or transit benefits. And keep in mind, these are all and more than 50% of use of your spaces is for use by the general public, as we talked about in the previous slides. If you can kind of get over those three hurdles, then you're not going to be impacted by the new parking tax rule. So you've got to be able to meet all those three. You're not paying a third party specifically for employee parking on their behalf or providing transit benefits. You don't have any employee-only parking reserved spaces for your employees. And then when you look at the spaces, more than 50% of that use on a typical day is going to be used by the general public and not your employees. Then you get out of it. I guess there's one minor caveat is that if you go through, let's say you have never filed a 990T before, and you go through and do the calculation, and because either you have very few reserved spaces or because of the expenses are very low, if you were under $1,000, you have to have at least $1,000 in gross income to be required to file the 990T. That would also be one where you may actually have to calculate the tax, but you might not have a filing requirement. I think for most of the clients that we've dealt with, most of them have been impacted by the new tax rules.
So given the fact that this is a new tax provision and there's very limited guidance out there so far, are there any relief provisions that are available to nonprofit organizations that are just now becoming subject to this?
There was, within the notice itself, there was a caveat that said that employers could have up until March 31st, which is just, the end of this month, to change their current parking structure and to treat that as if it was done retroactively to 1/1/18. That could be either completely doing away with your reserved spots or reserved employee parking, or just changing it so that the amounts that you're actually going to have to allocate expenses to were less. So maybe you still offered some type of reserved parking, but not as generously as it previously was. From a practical perspective, a lot of our clients haven't chosen this March 31st option. I think primarily it's because they have a significant non-tax reason for how they have their parking structured, and because there's still this question mark of, is it possible that this might get repealed? That hasn't been an option that's been necessarily super attractive. Although it may work for some organizations, and we definitely want you to know that it's out there, depending on how complex your parking situation is. And, if you aren't really following I know how we have some clients that say, well, we technically have reserve, but we have so many spaces, it's just parking's not an issue for our organizations, then this might be a good option to say, okay, we're going to change the signage, we're going to change how things are structured, and so that we're not running afoul of these rules. Well, you have until March 31st to do that. The secondary notice that came out at the same time was this notice 2018-100. If you have unrelated business income tax that's due, whether from other activities or as a result of the parking tax, you are required to make estimated tax payments. And so generally, so if you had not made these estimated tax payments, you may have a potential penalty for failure to timely make the estimated tax payments throughout the year. This notice 2018 just provides some relief on the timely filing of the estimated tax payments, but you have these additional requirements that have to be met, and so it's somewhat limited in scope. It has to be that this is the first time that you're ever having to file a 990T, and you're doing it as a result of this new parking tax, but you also have to timely file and pay the tax for the Form 990T, or have paid it in with the extension. I will note, I think one of the questions that came up was, when would this have been due? The 990T due date is a separate form. It's due the same time the Form 990 is due. It is a separate extension. So I think we've seen, I think probably several people who have gotten kind of surprised by this, because the position that they took prior to the guidance being issued, based on kind of the best information we had at the time the tax return was due. So we have a lot of June 30 clients, and so their first tax return due date for the 990 and 990T would have been November 15th of 18. This notice didn't come out until December of 2018. So where they maybe thought they didn't have a problem, then as the notice gave us more information, this has become a problem. I think from a practical perspective for clients, organizations that are getting penalized by this, that I think the IRS is probably going to be somewhat generous in penalty abatement under reasonable cause, just saying we didn't know that we were impacted by this because of the timing of when the notice came out, that it took time to be able to gather the information and quantify this. So I know, for any of our clients that might be impacted or who receive a notice, that would be a position that we would take, is just to request abatement of any penalties due. Still have to face the interest on any payments that might be due, but would at least have probably penalty relief.
Yeah, I think also important is for those organizations that aren't required to file a 990, and so kind of this would have really been something new to them, not even potentially knowing when the 990T is due, because they don't even already have the 990 kind of on their radar. I think that would be another, possible reason for getting out of the penalty, is for those organizations that aren't even filing that.
Right. Let's go ahead and go into polling question number 4. Does your organization anticipate making changes to how it provides parking to its employees as a result of this law change? Yes, no, or not sure? I will say on a side note, I know we've got a lot of questions coming in through the question poll. We're going to try to, I think, just try to go through the presentation. There's a lot of information in this notice that we're trying to get through, and we will try to hit those questions at the end if we have time. If not, we'll try to circle back separately based on just the information you've provided. We'll try to reach out to you separately, or feel free to reach out at the end of the presentation. Amanda and I should have our email in there, so if you need to reach out separately, we can try to address any specific questions that might be unique to your organization that we didn't have time to cover in the more general presentation. Let's go ahead and close that poll out.
All right, so I think that's probably pretty consistent with what you were suggesting, Rachel, that many organizations are not anticipating making any changes to their parking structure. Although we have to take into account tax considerations, we can't let them always drive how the organization is going to operate. So let's walk through some examples. First off, let's take a look at an employer that is leasing spaces from a third party, and they have a fiscal year ending in June. So in this example, they're leasing 40 spaces, 30 are for employees and 10 are for visitors, and they're paying $120 a space per month. So their total amount that they're spending during the year for parking is $57,600. The amount that they would need to report on their 990T as UBTI from disallowed fringes would only be $21,600 because you're only looking at the portion that's attributable to employees, not visitors, and you're only looking at the 6 months beginning 1/1/18. So hopefully that, kind of makes sense. That issue is going to go away over time. It's just sort of in this transition period. Fiscal year organizations need to remember that they only need to be looking at expenses paid or incurred after 12/31/2017, even though the 990T is technically reporting on their longer fiscal year. Here's a similar example for calendar year organization, same set of facts. We've got, 40 spaces being leased at $120 a month. Same total annual expenditures, $57,600. Because they're a calendar year organization, they're looking at their expenditures throughout the entire year, but they are allowed to exclude the expenses related to the visitor spots. So their number is only $43,200, which is essentially 30 times 120 times 12. That's what's going to be reportable on their Form 990T. So let's add a little wrinkle into it, and this is something that we hadn't specifically mentioned earlier, but is important to keep in mind, which is that there is a cap on the amount of the benefit that can be provided to an employee tax-free. That was $260 a month for 2018. That has increased to $265 a month for 2019. So if an employer, as in this example, was paying $280 a month, only $260 of that amount was allowed to be treated as a tax-free benefit, and the difference, or $20 a month, would have needed to be reported as a taxable fringe benefit to the employee. So in this calculation, their total annual expenses are $134,400, but we're, again, only looking at the expenses relating to the employee spots, and we're only picking up 6 months, and we're only picking up to the cap of $260 because that is the amount that is the pre-tax, the non-tax benefit. Over the $260 was treated as a taxable benefit, and so by virtue of the way the code sections work, that doesn't need to be included as UBI for this purpose. Similar example for the calendar year, again, just factoring in that it is going to be for the entire year because that it does cover expenses paid or incurred after 12/31/17, but again, looking at the cap and looking at only the employee spots, not the spots that are for visitors. So it seems fairly straightforward when we've got the paying the third party for parking. But let's make it a little more difficult, and let's walk through the example that would pertain to most of you. I think it was about 70% per the poll. You're owning or leasing your lot. Let's kind of walk through a couple of versions of that. So this is following the reasonable method outlined in the notice, which again, as Rachel mentioned, is an example of a reasonable method that the IRS has proposed. Because this is interim guidance, you do not have to adopt this method, but should you choose to adopt this method, you would have comfort in that the IRS has deemed it a reasonable method. So the first step is to allocate expenses to reserved spaces. So in looking back at the information that Rachel mentioned that you needed to gather, this is where you need to factor in all of the spaces that are reserved specifically for employees. So in this example, we've got 250 total parking spaces, 30 of which are reserved for employees. So that comes to 12%. So assuming our parking costs for the year are $50,000, then 12% of $50,000 or $6,000 is going to be unrelated business income at a minimum. That's kind of where we're starting. Then we continue on to step two. Step two is where we determine if the primary use of all of the non-reserved spaces applies. And the primary use test is defined as more than 50%. And so more than 50% of all the remaining spots must be for use by the general public, either available for use or actually used by the general public. So in this example, 70 additional spaces on average are used by employees, and the remaining spaces are either used by the general public or are empty, which means that they can be attributed to the general public. And so that percentage gets us 68% of the remaining spaces are typically used for the public. Since that's greater than 50%, we're complete. We've met the primary use test, so the remaining parking costs of $44,000 don't have to be further allocated. So I think that's a good result, because even though employees are technically using those spots, under this reasonable method that the IRS has provided, you're not required to allocate any expenses to that. So let's go through a version where they don't qualify for the general public exception. What are the remaining steps that we have to go through? So in this second example, they fail the primary use test because 170 spaces are used by employees. So that means that only 22.73% of the spaces are used by the general public. So we haven't met the greater than 50% test, so we have to go to step 3. Step 3 has us allocating expenses to reserved non-employee spaces. So these would be like visitor parking only, student parking only, spaces that are reserved for members of the general public, not employees. And so that gives you a fraction of the remaining expenses that can be carved out of the calculation. And then the last step is to allocate any expenses that are left over. And so these would be expenses that haven't been allocated to reserved employee spots or reserved non-employee spots. And this is going to be allocated between the actual or estimated employee usage of those spots versus the general public usage of those spots. And so in this example, we have on average 170 employees using the 220 non-reserved spots. So we allocate 77.27% of the remaining costs. That yields us unrelated business income of $30,908 in addition to the $6,000 that we identified in step 1 that's attributable to the reserved employee spots. Now, I know we had a question come up in the question pod, and I actually had this question come up with a client the other day, which is, how do you go through this calculation when you lease office space? And as part of that office lease, your employees and visitors are allowed to park in the parking garage that is next to the office building. And the office building does not require a parking tag or a badge to enter the garage. There's no restriction. Anyone can come in and park and not be charged or have to have any kind of pass. In that circumstance, how do you kind of compute this test? It is challenging, and I know it's an area that organizations like the AICPA are seeking further guidance from the IRS on. But one approach that Rachel and I had discussed that would allow you to kind of fit in with this methodology would be to consider the number of employees that the organization generally has parking in the lot or garage, and the number of visitors that it normally has. Now, you would skip step 1, you would not have any reserved employee spots. So really you would be looking at the primary use of the parking. And if the primary use was for employees because the organization didn't have many visitors, then you would need to move forward into step 4, which would basically be to apportion the parking expense between the employee usage versus the visitor usage. The really tricky part would be allocating the expenses to parking, because you would presumably be paying an amount for your office space, and there would not be a separately stated amount for the parking aspect of the office lease. there would likely not be a value associated with it. If the parking is freely available to the public, then probably you're in an area where parking generally is freely available. So there wouldn't necessarily be a representative fair market value that you could use to allocate expenses. So you would need to develop another method of allocation, potentially talking with the landlord, seeing if they had ever made any calculation as to the value of the parking, or perhaps it could be based on the cost of the parking compared to the cost of the office space. But you would need to come up with a reasonable method potentially for allocating the office rent to parking. Okay, so let's move into some implementation considerations. Clearly, this can be very difficult. You know, different organizations have different parking arrangements. Rachel and I are finding out firsthand how many different parking arrangements there can be. But we've wanted to highlight some of the things that we've kind of come across and things to consider. So expense allocation methodologies, you know, that's going to be number one when you're not paying a third party. And many of you had indicated you're not specifically tracking expenses for your parking facility. So you're going to have to allocate some sort of more general facility type expenses. And, you know, that can sometimes be based on, you know, square footage, if that makes sense, or some other factors. I know insurance, for example, you might want to look at, you know, liability insurance, you know, that covers the parking areas. Maybe the insurance provider might be able to provide information as to whether a greater percentage of the premium should be allocated to parking areas because accidents happen, you know, more often there or not. Another important thing to consider would be like if you're allocating, you know, some employee-related costs like security, maintenance, you know, if you had time records or anything that might indicate time that they spend on parking areas versus other areas. But you will need to kind of consider what would be the most reasonable approach. Another thing to consider is normal business hours. So a lot of these counts of, you know, when employees are there and visitors are there, you know, that's in an organization's normal, you know, business day, which can vary. You know, universities that have evening classes and early morning classes, you know, their day might be a lot longer than, you know, a more traditional 9 to 5 type organization's business day. So that would need to be taken into account because sometimes organizations have parking activities after hours, and that would need to be considered separately if it's not related to their normal operations. Again, we can't stress reasonableness enough. You know, clearly if there's not something specifically outlined that is a requirement that you have to follow, which is the position that we're in now with this interim guidance, clearly the organization's only option is to do, you know, what is reasonable, developing a reasonable method and approach and documenting sort of how that approach makes sense and why is it reasonable, you know, not just sort of coming up with the method that will yield the lowest amount without any sort of support for why that would be reasonable. You need to try to figure out how that can fit in with the guidance that is available and sort of corresponds to it as much as possible, even if it isn't identical.
Hey, also, Amanda, on that reasonableness thing, I was just going to chime in on that. I've seen on the flip side that as clients, if we've worked through clients trying to calculate this, that they've gone to the extreme other side and gone maybe overboard on expense allocations for costs. Maybe they picked up all of their security department, but their security would cover security for the grounds, but also for the parking facilities, but they've not done an expense allocation. And so you really want to kind of think through what is parking lot specific, because it can be easy to kind of run your reports on these different, depending on how your accounting system captures things. You kind of want to go through and get a general idea of what expenses may be related to it, but then kind of go through and specifically say, are these specifically related to the parking lot itself? If you've got security that's campus security and they also do parking, then you've got to start thinking about expense allocations. And so I just want to point out that as you reasonableness doesn't necessarily mean you're paying the most amount of tax, but that you're just going through and making an allocation and thinking of what do we need to consider with respect to implementation.
Yes, good point. I think another thing we wanted to kind of point out is that, expenses that have to deal with general sort of public spaces and not necessarily specific parking areas might not need to be included. Kind of looking at expenses that might not affect the parking lot that is being used by employees and visitors should potentially be excluded. And also, if for those organizations that are providing this as a pre-tax benefit, you might want to consider, I've heard of many organizations, that did not want to have unrelated business income have ceased offering this as a benefit. But I know that there are some jurisdictions where employers of a certain size are required to offer parking and or transit benefits to their employees, so that would also need to be kind of factored in. Budgeting for new expense, if now the organization is going to be paying tax on providing these benefits to employees, kind of factoring that into the budget and kind of thinking about that going forward. Potential new filings, as we mentioned, the Form 990T, if the organization was not previously filing that for unrelated business income, kind of having that on their radar as far as needing to file it, kind of budgeting the expense for preparation of that as well. State tax returns may also be due because most states, in fact, do tax unrelated business income as well. Estimated tax payments, as Rachel mentioned earlier, those are required when the organization's unrelated business income tax exceeds $500. Those tax payments need to be made on a quarterly basis using an electronic system that takes time to get registered. So that's something to kind of consider and make sure you're prepared to implement if you're not already there. And then state tax treatment, as I mentioned, states generally, tax unrelated business income kind of based on the federal amounts, but there are some states that have decoupled from the tax law changes. So like, for example, North Carolina has said that they will not include as unrelated business income this new, qualified transportation benefit expense, but that is as of 1/1/2018 for tax years beginning 1/1/2018 and later. So for those organizations with fiscal years, there still kind of is that gap period. They still would have to report for their 1/1/18 through June 30/18 because that was a tax year beginning before 1/1/18. But for organizations in other states, it may be difficult to kind of pinpoint, what the state has determined. But that is something to consider, as that can be an additional filing requirement and expense. As we're kind of wrapping up, we only have about a minute left, so it doesn't look like we'll have much time to cover questions. I've kind of scrolled through them, and a lot of them, kind of are sort of nuanced and have come up before, so I think we will want to reach out to you about them. I think, the biggest thing is, as we mentioned in the beginning, this new tax does apply to qualified transportation benefits, which includes not only parking, but also transit passes. We've been focused on parking as we found that is not as straightforward. And we hope that we've provided some insights into kind of what the Notice 2018-99 has provided as a reasonable method, as well as some factors that you should consider in potentially determining your own method. And please don't hesitate to reach out to us if you have any questions, if there's anything you think we didn't answer, or anything we can help you with. Please don't hesitate to reach out. We've enjoyed having this time with you today and hope we've helped you understand this new provision a little more. I'm sure there will be more to come from the IRS, hopefully before too long. Thank you very much. Hope everyone has a great day.